most importantly, what we talk to our clients all the time is that you can't out-earn a spending problem. So, right?
That's a good way of looking at it.
I think I'm a decent investor, but if you're spending too much money, there's no stated return that I can give you that's going to, keep your portfolio intact if you're spending too much.
Welcome to the Zacc Call Money Education YouTube channel. This video is different. In the past, we've gone through and done the Guided Path series. So that is where we have episodes part of an entire larger project or a larger series. So we have the Guided Path, and I'll be coming out with a whole nother series called the 7 Prosperity Projects, which follows the book that I wrote that lays out exactly what decisions you should make in a specific order to be good with money. Today's different than both of those series. Today's a one-off episode where we're bringing in a guest who is an expert in his field, and I think you're going to love the conversation because I hear a lot about alternative investments and how sexy they are, how exciting they are, and while they can also be dangerous. They can also be limiting in terms of liquidity. So we're going to unpack a lot of that. And Richard Ward is the guest today. He is the Chief Investment Officer of Curated Wealth and one of the 3 founding partners. So we have Richard in our studio today. We'll dive into this. I'm hoping that by the end you walk away with a very clear understanding of the alternative market landscape, who should be using alternative investments, and then how to do it right. So excited to have you here, Richard. This is totally new. I'm on the opposite side of the table, which I'm excited about.
Well, thanks for having me. This is great. I love it.
Well, thank you for coming in. So that everybody knows, a couple things to make sure people are very comfortable with. Curated Wealth Partners is an investment advisor firm that has clients that are very high net worth. Therefore, you end up in that space where you are looking for alternative investments to your standard stocks and bonds and public markets. Capita Financial Network, our clientele is typically between $500,000 to $30 million, and it feels like you guys pick up from that space of 20, 30 million and then up. And does that sound about right?
Our average household is worth about $150 million.
Wow.
And you're right in that we do a lot of investing in what is deemed alternatives, but as you said, we'll unpack that. One of the thing that I think is super important to investors these days is to demystify what that word really means, because it doesn't have to be that complicated.
Right. So a couple things for people to know right out of the gate is that we do have a relationship where we do pass clients. We do, let's call it, refer clients to each other when the other firm is a better fit than we are. So that's part of the idea, is to make sure that people have access to the best advisors possible for their particular client situation. And then the other thing to throw out is we're going to get into a topic that I think people could accidentally assume, like, oh, Richard and Zacc said I should do X, and we're not doing that today. We're not giving like specific personalized advice that requires us to know your situation. My compliance officer would love me to clarify all of this. Yes. This is not for you specifically. This is for you generally. This is an educational conversation for you to understand, how do I even approach this space? And then once you know the lingo and how to approach the space, that's when you work one-on-one with someone like you to really figure out, like, okay, in my situation, how does it get allocated?
This is definitely not a space that you go it alone. You're going to want to, as an investor, work really hard to understand it, and then work closely with your advisor in understanding what investments are appropriate for your risk tolerance, your long-term goals, all of that. Because you're stepping into a world that primarily has less liquidity than we're used to. Investors, we start with trading in public markets that have what we refer to as trade plus one liquidity, which means you trade a stock or a bond and you get your cash tomorrow. Most of the investments that we're going to discuss today do not have that feature, and so that's super important that you're working with your advisor and understanding what you're investing in.
Okay, great. Okay, let's get a lay of the land here. It seems as though when I started in this industry that I could go and look at small cap stocks and get some really exciting new businesses that maybe were worth $100 million. And then through the course of the last 20 years, they talked about the unicorn, private businesses that are billion-dollar firms, but they're not public. And that was really kind of shocking. So expand on that, Richard, because you know this market better. What's going on in the public versus private markets with regard to alternatives?
Well, that's one of the reasons that alternatives has actually grown in utility for advisors. If you looked back on the trailing 15 or 20 years, what you just referenced, Zacc, has remained to be true, where the entire cap spectrum of micro and small cap has almost been wiped out of the market because companies have decided to stay private longer, and companies have actually grown to be tens of billions of dollars, if not larger, in valuation while they're still private. And so investors, to find those opportunities, and by the way, you can wrap your head around it fairly easily. Think about how big Uber was before it went public. Think about the fact that SpaceX is still private, and Elon Musk is building other companies that are very, very large and still attracting private equity investing. And so that's all it really is. Let's simplify it and say, when I buy equity in Apple, I'm buying common equity into that business to earn the profit stream of what they're making. I can do the same and buy private equity into companies that are still private, that don't have publicly traded shares, but I can invest equity dollars into those companies.
And it seems like people think that it's way more complicated than that. Like
Right.
they think that private equity and public equity are not similar, which they're not the same, but you're saying they're fairly similar in the sense that you have ownership.
You're still buying ownership of the profit stream of this company, assuming that they're profitable. But to your point, over the last 15 or 20 years, because those many companies have delayed their appetite to go public, or ever, investors have gone to seek those smaller, faster growing opportunities in private markets. The other thing that has evolved in the time that we've been doing this, and I've been in the market now doing this my whole career, pushing 30 years now. The utility of alternative investments to private individuals has grown, and the access point has grown.
Can you explain that? Like, what do you mean by utility and access point?
So it used to largely be a stomping ground that institutions would invest in. So large insurance companies, endowments of large universities, pension plans. They had the wallet size to be able to take a very long hold horizon. So think 10 or 15-year hold horizons for some of these investments. Their denominator, right, the capital that they're investing in, can have that super long horizon without them needing to access it. What has changed is that some of these investments either have now a shorter hold horizon, maybe a 5-year investment, some are in evergreen strategies, some actually throw off cash flow, to where a two-legged individual now can invest in them with a little bit more comfort without sacrificing that 10, 15, 20-year liquidity. The other thing that has changed is that the larger asset managers that traffic in alternatives have seen an opportunity in the wealth space, right? Our businesses have grown quite a bit to where individuals have become more informed on how they invest. They've gone out and sought professional advice in doing so, and advisors have been able to take them in that direction of exposing them to these different areas of the investment landscape, which has included, air quotes, alternative investments. So again, we've been doing this for our types of clients for 20 years now, but I've seen an arc where it has changed, and there has been more availability to smaller wealth households to invest in these types of vehicles.
Interesting. It seems like there's been a convergence of the assets have become available at a lower wealth level, and it seems like there's more wealth out there to be from individuals to be investing in these types of assets. It seems like a company who wanted to raise money beyond a value of $100 million almost had to go public to find enough investors, whereas now they can satiate that interest just with private money out there. It seems different in terms of, just seems like there's a lot of cash. Is that fair to say?
That's definitely true. So the check sizes that the asset managers will take are smaller. It used to require at least a $10 million minimum investment from a single player to even have access to these funds. And to your point, investors have grown in the way that they save for the future, where they're not just investing their retirement, right? They have money that they've put in the bank that they're not just keeping in a savings account, that they're actually investing in their brokerage account or with their advisor. So both of those things have changed to increase the pie, if you will, of access point. What I would also say that's really important as we go through this is that there are a lot of asset types in alternatives that are hard to access through normal markets. So, for example, if we were to buy this building, right, it's a very different risk return profile than if I was to go and buy a publicly traded REIT. They're both characterized in our investment portfolios as real estate, but they have a very different risk return profile, and more importantly, a liquidity profile, right? Think of your personal home. You're not out there every day thinking about selling it the next day and constantly getting a bid. You have that for oftentimes a 30-year hold horizon, because that's how long your mortgage is. So real estate is probably the most tangible asset class to wrap your head around why you may need to go into an alternative investment vehicle to get access to directly owning that asset type.
Yeah, because this building is not available on the public market.
Correct.
Like this specific building is not, and it's owned by 3 entities that were all partners, just a bunch of people who actually work in this building, all decided to pool money together. Right. But it sounds like we could have said, instead of us all trying to come up with the money to buy and fund this building, we could have said, hey, we need a few $1 million to help finish funding this building. Let's go put this out to an alternative fund provider or alternative investments. And they could have gone to someone like you and said, hey, who wants to have a piece of this building? Is that what you're saying?
Correct. Yeah. And then what you would do from a portfolio construction perspective is deem that as private real estate. That's where it fits in my portfolio now. And what's great about it is that now you've increased the diversification in your portfolio. When the public markets, bonds or stocks, zig, the idea is that this will zag, right? And then you start to introduce other asset classes, whether it's infrastructure, private credit, even other ways that people are using public markets to invest in different vehicles to lower the correlation of your portfolio. And all that means is that, like I said, if one part of your portfolio is zigging, the other one should zag, so that you're not having these you're not experiencing the big drawdowns that you might get when the markets get disrupted, because the alternatives part of your portfolio might be holding up better than the public stock market.
Got it. Okay, so I'm going to do something here. I'm going to switch our second and third bullet point, because we're going to cover who, when, and how much later. Can we dive right into what you just talked about, where give me the top, whatever their number is, 5 to 7 to 8, like top categories of alternative investments that if I wrapped my head around, if you understand these 5 classes, you've got the lay of the land for alternative investments. What are those?
So we already covered one, which is private equity. So, and there's different, same with the markets, where you can buy a mega cap stock, an Apple, and you can buy a very small cap stock that you and I don't even know the name of, a small biotech company. Private equity accesses different sizes of private companies by way of writing equity checks into them, okay? And that's very simple way of explaining it. When you get down to different size of companies, and it's usually graded by EBITDA, by profit, they start to go into areas that are known as either growth equity or even venture capital. And all that really means is you're taking more risk as you go into smaller companies, because they might be early in their process of development. They may not even have a product yet that has revenue. So that in general, you can characterize that space as private equity, and it goes all the way from leverage buyout to regular private equity to growth equity down to venture. So that's one category, and then just deem that as equity.
Okay, we're going to do real quick. I'm going to drill a little deeper on that. So starting at the bottom, venture capital, I'm going to tell you a couple things. You tell me if I'm even close. But venture capital, my impression is possibly and maybe most likely not profitable. Could be a wonderful growth business, but they could be losing a lot of money every year. Very high risk. And who knows? It's kind of like throwing money out there for a lottery ticket, hoping you win. And then as you move up, you're talking about growth equity. And you talked about, which I assume growth equity is like, hey, we have a little bit of a more proven track record on this. It's likely to experience higher than average growth, but it's not this stable business producing a crazy amount of cash flow.
Maybe they're break even. There's a proof of concept product. Maybe they're right on the cusp of becoming profitable, but they need another kicker of equity capital to get there, right? Where you're right in venture, which is, it might be just a guy with an idea. And it might be a couple guys that came up with an idea of using an app to take out the taxi industry, but they need equity to go out and develop it, build it, and they're going to need a 5-year run rate of money to burn through before they even know if it's going to be profitable. So that's obviously what Uber looked like very early on. and keep going up. Okay.
Yeah. So you mentioned, and obviously for the audience, they need to understand that, yeah, your biggest money could be made in the earliest investment in the company, and your biggest money could be lost in the earliest investment in the. So higher risk, higher return, the earlier you get into these. So venture, growth equity, and then you said leveraged buyout. Was there one in between the two?
Regular private equity, which are basically, you oftentimes will read in the Wall Street Journal of a take private. So there are oftentimes big asset managers will go to a publicly traded company and effectively take the company and buy the public equity shareholders out and take that company private. And the idea is that maybe they see something in that business that they can break apart, create more value, and then maybe they'll take it back out to the marketplace and take it public again after they reorganize it. So that's a way of a take private equity structure. Okay. And then leverage buyout is probably one of the most classic examples of private equity, where same thing, where a sponsor will basically go out, buy a business, take a ton of leverage out to go and basically borrow from the marketplace to build the business in a different way.
Well, okay, then, you're going to have to back up for a second.
So,
and I'm going to do that every once in a while.
But don't overthink it. The bottom line is, again, you're just accessing companies that are private in different ways. And the bottom line is, as we just walked up in the different types of investments, is that your hold horizon and your risk has gone down as we walked up because the companies are larger and more proven.
And they've got hopefully cash flow and positive.
Correct. So let's not spend too much time
on that. Okay.
It's
but the bottom line is, somebody comes in, is able to use credit or loans to be able to fund and buy and actually grow the business beyond that point.
Correct.
Is that right? Okay.
And let's also take a big step back. Really, all alternatives is they're vehicle types. So you're effectively just buying into these different asset categories through a partnership. That's all it is, right? And when you go into it, what we just described as going into doing equity, you can go into a partnership that all they do is debt, right? Yeah. So the same way where you can go into the public markets and buy treasury bonds, investment grade bonds, high yield bonds, there are limited partnerships that are providing loans to private companies.
We call that private credit, right?
Correct.
And so real quick, I'm going to give that because what we'll do is I'm hoping to give some visuals to the audience so that as we work through these broad categories at the top. So we just covered private equity and some of the sub-asset classes in private equity.
Yep.
And now let's dive into private credit. But audience, remember, we're giving you the broad category and then the underlying classes. So private equity, we hit the classes, private credit. Now talk to us a little bit how private credit gets broken apart.
That by the way, we could spend hours
on okay.
The easiest one to understand would just be direct lending. So you, in a partnership, you amass a couple $100 million of limited partner capital, and you champion a sponsor to go out and give private companies loans. So the same way in the private equity example, we're investing equity into those companies. Here at private credit, you're just doing direct lending into private companies. And it looks similar to what I just covered, which is treasuries, investment grade bond, high yield. The idea is that by sacrificing liquidity in a limited partnership vehicle, you should be getting a higher return. So the same way high yield loans might be, you get 7, 8, 9% in the public markets on those bonds. Because I'm taking more risk and the companies are smaller, in direct lending, I should be getting 10, 11, 14% of return on those loans because I'm taking more risk.
Right. And so I always try to think about who's on the other side of this investment. And in this case, you've got a private company who wants cash. And my understanding, and I'd love for you to clarify if I'm missing anything or add to it, but my understanding is if you are a private company, you might take on private credit because you're thinking, I really believe in my business. I do not want to give away equity. I don't want to take on a new partner and have them profit from all of the growth and cash flow from this business. So instead, I'd rather borrow. But in that case, they might say, it's going to be really hard to get money from a bank for our business in particular.
Correct.
And so they say, okay, I don't want to give away equity. I can't really get money from a bank at 4, 5, 6, 7, 8% interest. I guess my solution is I'm going to pay 10 to 15 to private lenders in this case. Is that how we end up there?
That's it.
Okay.
Yeah, you got it. And I would say that oftentimes 100% driven by the fact that maybe that company and the owners of that company don't want to give up equity. It also might be the fact that they just need bridge financing, right? They might have started another business and they need to maybe build another factory in another part of the country to create a better supply chain model for their business. And they're saying, we only really need that for 3 years, so let's go and tap the private debt markets to finance that. And once we're up and running, we'll be able to pay it off without giving up any equity of our company, right? So think of like CapEx projects that private companies might need. They might want a more compressed timeline of what they want to borrow without, because it might be project based, right? Without needing to necessarily give up equity in the company to do so.
Got it. And I think similarly to these business owners, for Capita in particular, we've thought about opening up new offices in other states because we're starting to get more and more clients because of this YouTube stuff we do. We get a lot more clients across the country, and I've thought about placing advisors in each time zone to better accommodate our clients' needs, right?
There you go.
And I would much rather pay interest of 10% if we needed cash. I mean, ideally what we'll do is we'll just take our cash flow and fund it personally and not need loan or equity investment in. But I would absolutely take a loan if I had to over some new partner because I believe in what we're doing and like I know it's going to do well.
And you have line of sight to when you'd be able to pay that debt off.
Should be quick
based on that, what you're expecting to build.
Exactly.
And that dollar of equity versus paying that interest rate, it hurts a lot more to give up that equity.
For sure.
So again, back to the topic set. Again, it's just no different than the public markets where you're deciding, am I going to be investing in this company in the debt part of the capital stack or the equity part or somewhere in between, right? Preferred equity, different characterizations of where you're investing in the capital stack.
Okay, so we did private equity, we did private credit. It seems like those are fairly easy for people to conceptualize because they can do like an analogy to public equity, stocks, and public credit, which is bonds.
Yep.
And I feel like once we get beyond private equity and private credit, it starts to feel a little bit more complex. What other categories are we talking about here? So
one that's broad based, I would say, is what's deemed as real assets, and we'll throw this back up on the screen when we go to produce this. Remember that the guidance of this conversation is all around like, why would you be adding this to a portfolio? And the idea is, again, to lower your correlation to if a certain asset class either has a great run or has a big correction like we've experienced last March and April, this most recent correction.
So we're 2025, March and April, just so people who knows how long this video stays out there.
Yep.
But keep going.
But we had a big sell-off in the market here in 2025 that was associated with the noise around potential tariffs in the U.S. If I own private real estate right now, the market was down, 10 to 15% in a matter of 5 weeks. The mark on my private real estate really didn't move all that much. I had a fully net leased building. All my tenants are super high quality. That building continued to have value and probably went up a little bit during that period of time. And I still got all my guys paying rent. So in the real asset category, you can kind of break it down to real estate, infrastructure, which I'll go back to what that is. There are institutions that put like farmland and timber in that category. So think about the idea of owning, a big row crop farm, right? That has continued yield off of it, and you could just own that land, right? That's a real asset. So all
like
these
own the land and then get lease payments from farmers, or actually own the production of the agriculture.
The former.
Okay.
Like, so you could actually there are funds that would go out and buy farmers actually out of their land and do a lease back. So the farmers, maybe they're on their third generation and they're rolling off, and they want to be able to monetize the value of the land and just pay a rent check back to a fund. But all of those things are real assets. Infrastructure is pretty easy to wrap your head around. Toll roads, ports, railroads, waste management plants. Then you get into like data centers, cell phone towers. They're all real assets that you can't buy and sell in the publicly traded markets. But we could amass a fund that goes out and invests in all those different things, and you're basically leasing those assets to the underlying utility. The best example is there's an investment that our clients are in that bought the majority of all the cell phone towers in Europe from Vodafone. So
In Europe, you said? Like
yes.
the whole continent?
Correct. So
Wow.
well, all of the cell phone towers that Vodafone owned.
Okay.
So let's make it an example in the U.S. Let's say I'm Verizon, and I own all of these cell phone towers, and they're on my balance sheet. Well, that's really expensive capital that is just kind of sitting there in a real asset. What if I found, and I went to you and I said, I'm going to sell you all these cell phone towers. So you're going to give me hundreds of millions of dollars back for those assets, and I'm just going to give you lease payments on those towers. Now I have hundreds of millions of dollars of capital overnight that I can go do other things with my business. Okay, by the way, the casinos did this with all of their land, right? If I'm MGM, I have all this money stuck in the ground in my buildings. Why don't I go and find someone, i.e. Blackstone, to buy the real estate from me, free up all that capital off my balance sheet? Because I want to be in the gaming business. I don't want to be in the real estate business. And I'm just going to pay Blackstone back for owning. They're going to own all my casino buildings, but I own all the operations inside of it. So those are two examples of what kind of real asset plays look like. And you could continue to go down the path of like, waste management plants or toll roads, all those different things that are a part of our infrastructure that you can own in a real asset bucket. But when you look at the slide that we'll end up putting in the production, you'll see that a lot of these assets that I just mentioned either have no correlation or negative correlation to the public equity markets. So when the public equity markets or public bond markets do one thing, these assets are supposed to do another in our portfolio, which should lower the volatility of our overall portfolio.
And we're using public markets because we're thinking, okay, if we can't get something different, if it's performing the same as public markets, but it's less liquid than public markets, why would we take on the risk of not being able to access our funds to get the same thing? So it needs to be something different. And for those of you who are looking at this, if we end up sharing it that way, let's just walk through what they're seeing. Basically, 1 is a correlation of 1 to 1. It's going to happen. It's going to move. It lock in step with each other.
Correct.
And anything positive means they tend to move in the same direction. But like a 0.5 means it's 50% correlated, let's call it, to in the positive. A negative number means it actually zags with the zig, like Richard's
Correct.
talking about earlier.
And so that on this chart, the dark green is really optimizing for low correlation, which means I've introduced something into my portfolio that actually will react the exact opposite to what it's negatively correlated with, has a low correlation.
Got it.
And that's idea is to get the correlation down in your portfolio, which will ultimately optimize the long stream return.
And your red here is basically saying like equity long short hedge funds are almost the same as global equities. So if you're thinking you're getting a lot of diversification by putting those two together, you're not.
You're not. And so let's talk about hedge funds really quick because they're also somewhat confusing to investors. And again, let's work on the idea of demystifying.
They also have a bad name at times, like a
sure.
nasty name.
Well, and the reason being is that they're these dark pools of capital that people don't really know what's going on inside of them, and you've had fraud, right? The Madoff, for example, was a hedge fund that ended up being a massive Ponzi scheme because the investors didn't have transparency into what the fund was doing. Now that has changed largely as a result, but same thing. Hedge funds are very simply just a limited partnership vehicle that is investing in all sorts of different asset types. So you could invest in a hedge fund that is literally just trading publicly traded stocks, but doing it in a format of long and short the market, maybe using derivatives, options, things like that in the structure of the portfolio with the idea of obviously making money. But most hedge funds, the stated intent is to be making money in any type of market environment, right? So my long public equity market portfolio, if the market's down that year, I should expect to be down, hopefully not as much as maybe the S&P 500. The idea in hedge funds is that I should be down a lot less or even positive return for that year. But hedge funds are investing in debt, equity, derivatives, all sorts of different things. But we tend to think of hedge funds more as just a vehicle type to invest in other other securities that you might invest in your own portfolio.
Got it. Or maybe in an approach that's different than what, like a combined approach of, like you said, long and short and derivatives and options all together in a very specific way that has to be done in a hedge fund because that's too many different objectives in one portfolio for a normal mutual fund, for example,
Correct.
to be able to
And
say
maybe
this is what we do.
It's a global fund, so they're investing in hundreds of different marketplaces over the world, right? Things like that are just hard to do in your regular way brokerage account.
Got it.
By the way, we just did the same in hedge funds. There are credit hedge funds and there are equity hedge funds, and there are some that play in between the capital stack. So the same way we broke down, private equity and private credit, hedge funds are just investing in different parts of the capital stack of either public or private companies.
And for those out there, just to clarify, I think when you're saying capital stack, you're talking about big companies all the way down to tiny companies, and in the different stack that way or a different way?
No, in a company, whether you're offering them debt financing or investing equity in the company.
Oh, I see.
Right.
Got it.
So
Capital
there-
contribution
so there-
to a company
correct.
rather than
So-
market cap stack.
Correct.
Okay.
The stack of the equity in the company.
Got it. Okay.
And all I'm saying is that there are hedge funds that specialize just in credit. There are hedge funds that specialize in equity investing, and there are some that kind of go up and down that spectrum.
Got it. Okay. So private equity, private credit, infrastructure, real assets, and we've talked about hedge funds. Am I missing anything?
That's pretty much it. I mean, you think that there are definitely other asset categories that have now, come in vogue, but that's maybe for the second version of this
Got it.
conversation. Because
Yeah.
there's all sorts of things that people have started to invest in now, which is like you could probably say that crypto is an alternative asset in some way. You could say art and collectibles, right? There's actually a fairly big push into royalty streams now. So you could buy as an investment, you could buy a music catalog, right? If an artist wants to sell and monetize their music catalog, you could invest in that. And obviously that has no correlation to what's going on in the public stock market, but you could get an income stream off of it.
Got it.
And so, but again, the reason that professionals are using these assets is ideally to bring up your longer term goal of your stated return of your portfolio and minimizing the volatility of it in the long term. That's really the purpose and intent of why you introduce these into your portfolio.
Okay. And I feel like most people, but not most people, a lot of the public will get really excited about alternative investments as this is how I'm going to make so much money. Yeah. It's going to be amazing. And I can see you shaking your head a little bit. But it's kind of like the government or the Fed has a dual mandate of employment and inflation. It's like private and alternative investments have a dual mandate of, yes, excess return, and you're trading something for that, usually liquidity. And at the same time, lack of correlation or low correlation is kind of a dual mandate. Am I understanding that right in terms of as you add these into a portfolio?
Well,
what you're looking for?
Mostly the decision-making point has a lot to do with liquidity. Like, do I need this money? Am I investing in an asset that's even cash flowing or even has the potential to cash flow? What's my long-term realization? If I'm investing private equity into a company that never has a plan to ever go public, how am I going to get my money out of that, right? So, a lot of it has to do with liquidity, and that's why this is not for everybody, right? That's probably one of the most important things that we need to cover today, which is it seems very sexy, and a lot of investors want access to it. But let's just say you and I have a $1 million investment portfolio, and we start investing in private markets, and we are investing in stuff that has 10-year liquidity, right? So I'm not going to have access to the parts of my portfolio that I put into it. But these investments have $100,000 minimums,
which is low. It seems like $250,500.
Now some have gone down to $25,000 minimum checks.
Okay,
but let's start with the $100,000 example, and we only have $1 million portfolio. I invest in 2 of those, and I've already sacrificed 20% of my portfolio to illiquid investments. All of a sudden, I'm now concentrated in those 2 investments, right? I've sacrificed 10% of my portfolio into 2 specific investments into 2 very specific categories. If it's in one company, I've actually gone the other direction. I've I have not diversified. I've actually increased my concentration in my portfolio. And so that's why, the bite sizes and the liquidity profile, you have to work with your advisor if you start to go into private markets, if your portfolio can even tolerate it from the asset sizing.
Got it. At what level do you feel like, and this is obviously there's optimal and like not suboptimal, and you're just trying to help clients feel happy about their portfolios. But let's say that you're looking at an optimal situation. At what level of investable assets do you hit where you're thinking, great, I have enough to work with here that I can build a diversified portfolio with diversified exposure to all these alternative asset classes?
That's a really hard conversation. It's really case dependent. It's where is that client in their, the arc of their lifespan? What is the capital going to be used for? Right?
Let me throw out maybe a more specific example, and I don't mean to pigeonhole you into having to give an answer, but maybe I think the people want to know, like, when should I talk about this? But let's say someone has $10 million and they are 40 years old. In other words, they do have a long time horizon. They're continuing to earn $500,000 to $1 million a year. So they have a lot of personal good cash flow. They feel like their income and their business is going to continue to produce income. So they really don't have the liquidity need. At the same time, 10 million, I know it's a ton of money, and I don't mean to be insensitive to anybody out there listening, but it seems like, at least to me, that has felt like a bit of a starting point.
Oh, for sure.
Right?
I
for
actually
this?
think, in fairness, I think you could probably go down to 5.
Okay.
If, very bold print, assuming that you're buying into very, very diversified vehicles that we just covered. We're not talking about writing single checks into one company. We're talking about buying into a big diversified pool of private real estate or a big diversified pool of infrastructure, right, at those smaller dollar amounts. I think a portfolio of $5 million or $10 million could afford to have 15 to 20% of their capital in alternatives that we've just talked about, assuming that they're going into large diversified pools.
And assuming they have time. We just talked about like this 40-year-old, right?
Correct.
Totally. I would assume the game changes entirely with a 65-year-old who's looking to cash flow out of that portfolio.
And it's also why these vehicle structures have changed. Most of them early on, when we were doing this 15, 20 years ago, were in what they deem as private drawdown structures, where there's a pacing of capital calls. They call your money in. There's a 3-year investment period, and then maybe like a 7-year unwind period. The asset managers have now figured out how to put these into evergreen structures, and all that means is that you're still buying into a partnership, but you might have to be in the fund for at least 6 months. But then you have a redemption window. For once monthly, you can ask for some of your money back. They also structure these vehicles in a way where they might actually cash flow back to you. You could buy into a direct lending fund that is evergreen in nature, that sends back monthly cash distributions of the income that you've earned off the loans that you've written. And after holding that for 1 year, you can ask the manager back for some of your money. So those are called semi-liquid evergreen structures that just live into perpetuity.
So you gave a couple numbers that I think are really interesting. I'm going to throw this out there so people know, but we look at the pools and the funds. We spent 2 or 3 years researching different platforms where we could get diversified alternative investment exposure. Finally found the solutions that we're excited about and feel comfortable with. And that's how we do it. So if somebody has $5 million, we might help them with $250,000, $500,000 to alternative investments, but that is going to go to 50 different individual deals at least because of the structure of the pools, right?
Correct.
So we're not worried about any one particular deal or one company ruining someone's life because of some stupid CEO making a poor decision.
So to that point, there's a very large evergreen direct lending fund from a very well-known publicly traded sponsor that at last look, it had 685 individual loans inside of that portfolio. So you're incredibly diversified just buying into that pool.
That's great.
So if one of those loans goes bad,
you won't even know.
You don't feel it.
You won't even know.
It's merely a flesh wound, right? Not even, right?
So, okay, but then going back to, you said, we talked about $5 to $10 million, and then you said, yeah, we could easily allocate, 10 to 20%. Can you give a range of, hey, like at certain levels, they can probably have more alternative investments, as well as certain client profiles where they don't need liquidity, they've got a long time horizon, they have high cash flow personally, like all of those things would push the ability to lock up your money in less liquid assets. And for everybody listening, liquid, what we mean by that is just your ability to take it back out and turn it back into cash.
Like we talked about, trade plus one. That's a highly liquid investment.
Which is the whole stock market.
Today in the S&P 500, I buy Google today, I can sell it in 2 minutes and get my money right back, right? Maybe it's obviously going to be at a different price, but it's highly liquid.
And that's really good clarification there, Richard, that you just said. So liquidity doesn't mean your ability to get it back at a specific price. It just means your ability to get it back at all.
Yes,
and to choose the time when you want to get it.
And choose when.
Exactly. So the ranges. Give us an idea of like, for Curated, you have $30, $40, $50 million investment. Is there a level at which you're like, hey, more than this amount of alternatives, we get a little bit nervous putting that much in?
So I'll just do a callback, Zacc, on probably 2-3 minutes ago in this conversation. We touched on a slide that talked about the different types of investments and why you might include them. And we talked about all three of these different goals, which were, do I want to generate income? Do I want to preserve capital, which would be kind of a real estate or infrastructure play? Or do I want to try to boost my return? So that roadmap actually will color in some of the comments that we just had about 2 minutes ago.
Because that's how you decide which of the asset classes, if you're looking for income, you're not going to be putting it as much in public equities or private equity. If you're looking to boost the return, then maybe it's private equity.
Correct.
So, okay.
So that should give the listeners a good spectrum of the different categories and how they fit from why you would put them in your portfolio and at what sizes. The question that you just asked me now is going to be on another slide that will also call up, which is how much of this should I start to introduce into a classic portfolio? We talk in our vernacular, and some listeners might understand what the classic 60-40 portfolio is. Most people refer to that as 60% public equity, 40% fixed income. The fixed income is always meant to be a preservation of capital income source, and the 60 is supposed to be growth capital, is meant to grow, and the combination is supposed to give me a nice diversified portfolio. Institutional allocators have now broken apart the 60-40 and have said maybe it should be 30-30-30, which is 30% bonds, 30% public equities, and 30% alternatives. And depending on what you introduce in that other 30, it doesn't necessarily have to be a risk-taking exercise. The diagram that we just showed before, maybe a lot of it is going to be income-oriented, right? And so I'm not necessarily introducing a lot of risk or growth capital. I'm just diversifying part of my fixed income pool. And so the spectrum that we'll call up, again, as a reference point is by adding different types of alternatives, you'll achieve different goals, right? In all times, you're going to decrease your liquidity, but some of these asset categories are really meant to be kind of preservation of capital income oriented, and others are supposed to be growth capital. Same way we used in our 60-40 portfolio, fixed income, bonds versus stocks. When you start to introduce different alternative categories, you can achieve the same goals. Am I seeking income and preservation of capital? Am I seeking growth of capital, or a combination thereof? And all it does is it lowers the correlation and ideally gets your return higher.
And for you guys talk to the individual client, find out what their priorities are, their life stage, their asset level, and based on that other matrix of, okay, here are your priorities between generating income, preserving capital, boosting return, and your overall risk profile, and your liquidity need, and your age, and your asset value. So you take all of that together and say, okay, here is a portfolio of alternatives in these asset classes. And then from an implementation standpoint, from our conversations in the past, it's like that's what we're hoping to get to, but it might take a while because it's kind of like this river that you're fishing in this river, and you have to wait for the right deals to come across before you really pull the fish from the river.
What you want, you're going to want what we call as vintage diversification. You're not going to want to go out and buy all your public companies in 1 year, right? Because you're basically hitting one window of time of valuations. You're going to want to spread that private capital out over multiple years, vintage years, and get access to it. You're also going to want to use different sponsors in doing that. Maybe there's a asset manager that specializes in just investing in tech companies, and this happens to be a really good environment to be investing in tech. And there's another manager that invests in consumer products, and it's not that good of a time to invest in consumer products. So maybe we'll stage that allocation out a little further.
And just real quick to clarify, are you talking public or private in this?
Private in this
okay.
instance, right?
Okay.
And then what I would also say, kind of back to the ratio of allocation, the leading sentence I started with, which was traditionally these were used at like kind of pension funds, large insurance companies, because their hold horizon is almost
Forever.
Infinite,
Yeah.
right? Our families pretty much have that same situation. Most of our clients, and when you get to a wealth level of 150 million, hundreds of millions of dollars and up, their money is going to outlive them. The main principle.
You would
right?
hope so.
And so right?
Right.
As long as they're obviously, smart about what they do and how they invest. And most importantly, what we talk to our clients all the time is that you can't out-earn a spending problem. So, right?
That's a good way of looking at it.
I think I'm a decent investor, but if you're spending too much money, there's no stated return that I can give you that's going to, keep your portfolio intact if you're spending too much. So let's just start with that as the premise. But largely, our client types are, their wealth is legacy capital, and so we're really investing it for multiple generations, and that's why we can introduce these asset types that have 10, or longer lives to live out on the investment thesis, because we can tolerate that long of a horizon.
Got it. Okay. So what I'd like to do is, this has been wonderful, and I feel like we've gotten a very clear organization, and I love like the idea of bullet points and categories because I'm a nerd. So I love that, the way we have those listed out. Now, I feel like there's a difference between idea and execution, and I'd love to spend the last little bit on execution. So an idea of getting private markets or private credit and infrastructure, real estate, and then sometimes people will go to the execution side of it, and they end up in layered products where there's a fee for this person, there's a fee for this person, there's a fee for this person, and it just stacks. And then they get to the point where the whole objective at the onset was to outperform what they could have gotten with the S&P 500. And then they layer so many fees that, yeah, maybe the underlying investment got 15% on average and the S&P did 11. But you're paying so much in fees and inefficiency in the structure that you ended up with 9 or 10 when the underlying investments performed at 15. You could have just bought the public markets at that point. So can you walk us through some examples of poor structure and execution and some examples of proper structure and execution?
Let's talk about just in broad concepts, the fee structure of most of these investments. There's usually at least two levels. One is an annual manager fee. So let's liken that to how we normally invest. An expense ratio in a mutual fund. Usually it's somewhere between as low as 10 basis points to as high as 1%, where you're paying the underlying manager to go and invest in stocks on your behalf, and you own that mutual fund, right?
And for anybody who doesn't know basis points, 10 basis points is 0.1%. So anywhere between 0.1% and 1, and we even see some expense ratios at 1.5 sometimes, which we don't like, but we see them out there.
That high.
Yeah.
Almost. So the range of manager fee in private vehicles can be as low as 1% and as high as 2.5% per annum. In addition to that manager fee, they're taking what's called a promote, or it's also referred to as carried interest, which generally says, for every dollar I make, I'm gonna take back a percentage of that. Usually it's a 20%. So there's something thrown out 2 and 20. 2 and 20 is 2% management fee, 20% carry. And so it means if I make any money for the fund, when I give you back the dollar that I made you, I'm actually going to keep 20 cents of it. So you're only making 80. And it's why when you start to look at the return stream of these funds, what you were saying, Zacc, is that you want to look at the net return, which is after all of these fees, what am I actually getting as an investor? Worse is that then you find, it's one of the reasons that we took our firm and went independent, is that the larger, mostly the wirehouses, the private banks, will actually charge their investors access fee. So not only is the manager taking 2 and 20, they're charging their client a 1 or 2% upfront charge just to get into the vehicle. And then oftentimes it's poorly disclosed. they're doing a recapture or a fee sharing arrangement on the back end where that fund is actually paying the advisor as well. And so as a listener, what you want to understand is what is the real fee structure, who's getting paid what for the entire time that I'm in this investment, because it's a little dirty secret about how much some advisors are actually making on these investments. And so it's really a fee proposition, not an investment proposition.
Right. And let me walk through that, because I can even add one more that's possible, which is our fee. You know what I mean?
Correct.
Like we're going, if we're going to do all that work, allocate it, monitor it, recommend it, create those connections, there's probably an advisory fee that is being charged on the whole asset portfolio. Yeah. And I have a lot of conversations online about fees, and of course it always causes people to comment, which is fine, and we can talk through it. And I think a lot of fees are unnecessary. I think a lot of fees are excessive, and I think there are really solid professionals out there that are worth paying a fee for. So let's just throw that out there. But okay, so let's say you have this 2 and 20, 2% ongoing, 20% carried interest. Then at some of the bigger institutions, they might have an access fee and may have back end, let's call it, under the hood
so
sharing.
those are called retrocessions.
Retrocession.
Which is a fee sharing arrangement between the manager and the either the brokerage firm or the advisor.
Okay, and the brokerage firm is thinking like, yeah, I have a big team of advisors, funds out there. If you want to be on our platform, you need to pay us money. So that's how that arrangement ends up existing.
I'm XYZ, wirehouse. I go out and raise hundreds of millions of dollars in one swoop for this asset manager. They don't have to lift a finger. Right. So I want part of their 2%. I'm going to take 50. They're going to take 1.5. That's what a retrocession looks like.
Then there are some arrangements where you have a financial advisor who's not involved in that. That's the idea of being independent, not being involved in retrocessions and not being involved in a placement fee, but basically saying, like, I don't want to have incentive to put you in any fund in particular. I'm going to charge you an overall advisory fee on everything that we do. And so that's one that can exist as well.
That's our model. And so one of the things that we're very proud of when we built our business is we got out of all that minutia, right? It was we wanted to go to a place that was very, very transparent to our clients. So we always discuss the fees when we go into any of these vehicles. We're not taking any retrocessions. We're not taking any participation interest, nothing from those asset managers that we're working with. We're simply charging our assets under management fee on those investments, because we don't want to be incentivized to push clients into certain areas if it doesn't make sense.
Yeah, it's wonderful not to care.
But yeah,
not to care which, but to care about the person.
And that's what you want to ask as a potential client is what's the alignment of interests? Who's being incentivized where? To get me into some of these investments.
And that was about 7 years ago, is what you're saying?
Yes, our firm, we founded the firm in September of 2018. So this September in 2025 will be our 7-year anniversary.
And prior to that, you guys, my understanding is you, Lee, Susan, have worked together for 2 decades, but had experience in these different structures, decided like, we don't love some of these structures. We don't love the way it's being done here. Let's break off and create our own independent group where we can have a better aligned structure and a better aligned relationship with clients.
Correct.
Is that right?
We came from the private banking world. We worked for some very, I worked at 3 very well-known large private banks. And when you're inside of those institutions, you start to question what are the alignments of interest here? Why are we being incented to sell this certain fund today? Why am I marketing a private real estate vehicle when the real estate market seems to be at peak valuations, right? Why would I be investing in that right now? Oh, it's because the firm wants one of the principals of that firm to be a client, and they want to raise $500 million for them. That's, what's the incentive there, right?
Yeah, that's too bad.
So that, I'm not saying that happens all the time, but it's certainly, you're wondering why they're pushing this product at such a at a heavy pace.
Okay, so to summarize, in terms of that's some of the poor structure that can exist. Let's say, like, talk to us. This maybe is your moment to shine a little bit. Tell us, like, okay, Richard, you're really smart. You've experienced all sides of this. You love this stuff, and how do you do it right?
Well, one is you really have to work with credible sponsors, right? There's going to be A lot of people that are out there looking to raise money, looking to want to, they want to earn 2 and 20, but maybe they're not that good at what they're doing. And so you want to obviously work with very credible sponsors that have a long-term track record, have a lot of experience in different, market cycles. You want obviously transparency in who's making money where. And what I would also say for us is that, when you have the ability, which is more relevant in our business, to negotiate the fee structure. Sometimes we'll actually negotiate general partner economics for our clients because we're coming with so much capital to
so
the
better
sponsor.
than the 2 and 20.
Correct.
Is what you're
so
saying.
Oftentimes we're in a position to be able to negotiate that, and we'll do that and we pass that back on to our clients.
Yeah, because a lot of firms that are big enough to negotiate it and keep it. But you guys are negotiating it and letting that flow through.
Correct.
That's
and because
different.
the way we think about all of our investments that we put our clients in, and it's because the majority of our clients are highest marginal taxpayers in California or New York, which is a heavy load. I love living in California, but it's expensive.
Mm-hmm.
You have to think about after tax, after fee returns. Let me stop there. After tax, after fee. In California, if I buy a debt instrument that is paying me 8%, if I'm a highest marginal taxpayer, immediately that number's 4. And if I have that manager charging 2 and 20 on that 8%, why the heck am I tying my money up? I can go get that in the public markets.
In muni
hand over
bonds
fist.
that are tax-free.
Correct.
Yeah.
Correct.
Yeah, that's a big difference.
So we start at the highest level of what is this investment underwrite to on an after fee, after tax basis, and then all of the other stuff that we just talked about for the last half hour.
Okay, here's what I'm gonna do. Let's wrap it up so we have Richard actually joining us for a live in-person session. We're gonna get to do this all again in front of a live audience, which is exciting. As we wrap this up, think about, if you're listening, think about this for a second. One, if you want to get to know Curated, if you feel like your personal profile matches what they've described as their client profile, I think you could reach out to them, and I assume you guys will take a call and just explore that with them and things like that.
By the way, I said that's an average wealth level of our families. We work, oftentimes we've met individuals that still have a lot of capital tied up in their main source of wealth. So they're not we talked about liquidity a lot today. They're not quite liquid yet, but they're on their path to becoming quite wealthy.
You get started helping them know what to do in the future.
And we're very good at that, as helping them pre-plan those events, helping them to work with even the little liquidity that they may have in the event that they get to, a larger wealth level. So it's not to say that all of our families are that level. I wanted to just color that in.
Got it.
Because we're, one of the things that we liked to say that we're very good at is helping our clients through the arc of their life, right? We've met many of our clients almost 20 years ago, and we've watched their wealth not only, grow to great levels, but we met them when they didn't really have a lot of that and they needed a lot of help in pre-planning. So
that's good.
Sorry.
So no, that's great. If you're in the situation where you're like, I don't think I'm a Curated client, but I want to talk about how to do alternative investments at the 4, 5, 6, 7, 8, 10, maybe up to even 15 million, then we're happy to talk to you about that. And if you get to the point where we're like, actually, you qualify for the conversations that Richard can have with you, we're going to introduce Curated to you as well. And then the main thing for you to walk away is, I really don't want anybody to think about this conversation as, great, I got my exact allocation of what I'm supposed to do with my money from Richard and Zacc today. That's not what this is, but hopefully you did walk away. That's my disclaimer of talk to somebody about your specific situation, and I'm hoping you walked away with a clear understanding of the broad asset categories within alternative investments, as well as some of the things you should watch out for, and most importantly, the vocabulary. Being able to walk into a conversation with an alternative allocator and say, hey, what's the carry? What's your fee structure? Is it 2 and 20? Do you negotiate that down? Do you receive any kickback from placement? Those are the types of things that you now are armed to be able to have a better conversation with your investment advisor and how they structure it.
I would leave with the point to color that in and saying that most of these products, unfortunately, are being sold, not invested in.
It's a lot
And
like
so-
insurance that way.
Correct. And so I would just, that's a cautionary statement in that, remember that idea of where are the alignment of incentives. If I'm investing in a fund, am I aligned with not only the advisor that's trying to pitch it to me, but also the underlying asset manager? Am I as closely aligned in my incentives as they are? Or is it being kind of sold to me as a product?
You got it. Thank you, Richard. This was fantastic. Thank you for tuning in to the Zacc Call Money Education channel. We're excited to have had Richard on to teach us about alternative investments. Like and subscribe to learn more.